Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinions as we go through it together. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com is where I dive deeper into all of these topics. I share my opinions much more freely on what I'm doing in this commodity bull market, how I'm playing it, the individual companies, why I like certain companies, and whatnot. There's the May Day coupon that is still active, 50% off the first month and a larger discount on the yearly membership if you're interested in the yearly membership. We've got a quote by Oscar Wilde. He says, "Nowadays, people know the price of everything and the value of nothing." That is where uh, that's where the opportunity lies. Most people are persuaded and base their narrative off of the price. So if something is falling, it's bad. If something is going up, it's good. And then they go with whatever emotional feelings they are feeling at that time based off of the price. But they have no idea what the value of anything is. They just go off of what price is. And that's all they know. Price going up, it's great. Price going down, it's bad. And price can move for a whole different variety of reasons. What you want to be looking at, in my opinion, is the disconnect between value and price. And then you also want to look at what causes the price to become undervalued or overvalued. What market conditions cause those valuation changes? And then you want to use technical analysis to marry up what the herd is doing as a way to gauge the progress of the price moving in the direction of where maybe the value is at. That is what separates people just running around blind in the dark and someone who has a strategy and a plan buying undervalued assets. Dr. Parik Patel says Intel Corp. He says he better be praying. This is a year-to-date chart. It's down 55%. And I know some people are saying, well, we're not in a recession. Things aren't slowing down. Look at this chart here of Nvidia. It's like, guys, look around at some of these other companies and they are struggling. But again, we'll see if this is a bottom or if it continues lower. This graph shows one basic thing that every uranium investor should accept and be aware of: volatility. If you want to make money on this trading, you have to ignore it. Be disciplined and buy on pullbacks. On the way up, there are all sorts of pullbacks: big, small, short, and long. The last uranium bull market, and they just took this from 2005 up to 2007, which was the top of the uranium bull market, the ultimate peak. We had all of these large pullbacks that occurred along that bull market. Now, one thing I want to make crystal clear here, and I know I've got uranium followers, I am also a long-term uranium bull. This movement upward was during a certain period of market condition. And I'm not talking about the uranium sector. I'm talking about when money rotates into commodities. There's a couple things that aligned here for this to really take off, in my opinion. We had a weaker dollar, and we had an expansion phase of real estate, which throws money into the system. During the expansion phases of real estate, which is a monetary growth of credit, that's when commodities do well. We have an area where we could pull back from a slowdown in the market. So the condition that this occurred under isn't the same exact condition that we have today. We have an inverted yield curve, which could be uninverting. We're seeing the 2-year yield drop. And that is a different market condition than this where we had the yield curve drop before it, the dollar drop, and then the yields were coming up a little bit during this time frame with the dollar dropping. Completely different market condition than an inverted yield curve dropping, the 2 year coming back down in a potential recession. Tell me, how many bull markets have you seen in commodities that occurred during the beginning phase of a recession, during a slowdown slash recession phase? There's very few. They generally pull back with the overall market. Then after you get that initial pullback, they generally lower rates. It can pull back maybe even further. Then we get another surge higher, so long that the fundamentals of commodities are good, which in my opinion they are. They are still good from a longer term time frame. So what's going to trip people up is that I am bullish and bearish at the same exact time on different time frames. And that's where people get really confused. They said, how can you be a bull and a bear? It's on different time frames. The short-term time frame and the yield curve potentially uninverting is a big deal. You need to be looking at it because that will generate a very large pullback in commodities in general, and uranium is part of that commodity group. And then we might have to go through that cycle again. They lower rates, they do some sort of stimulus thing, and then uranium moonshots. So think of this as potentially earlier in the bull market than what is being shown here. This bull market was '05 to '07. That was towards the end of the commodity bull market. I think we are more located time frame wise like 2000. And that 2001, that 2000 to 2001 era is kind of right where we're at. So we could get a pullback, a larger pullback in uranium and a lot of these commodity areas. And we are seeing evidence of that occurring, I think, with the S&P 500 and maybe the NASDAQ that potentially could roll over, like Intel, this guy going down 55%. These guys are starting to come out. Look at Nike. Look at some of the other retail sectors like Lululemon. Look at those areas that are retail driven. They're all coming back and they're down quite a bit. A lot of them, not all of them, but a lot of them. And that could be, signs of a slowdown. That is not the same market condition that we're looking at here. That's all I want to make sure that everybody understands that. The time to go big, in my opinion, is when you get alignment in market conditions, technical analysis, and ratios. Cheap, good setup that the herd is lining up and the sentiment is poor. And then the market conditions are good for an inflationary impulse move or commodities to go up in. That's full alignment. We're not in full alignment right now. So it's not time to go gangbusters. It's time to pause, relax, chill, maybe just watch, accumulate cash perhaps. I don't know, whatever your deal is. You can also look at other assets where those are in cycle. And those other assets we talk about. It says, is there really such a thing as a morning person versus a night owl, like biologically? Are you a morning? So I know this isn't financial related. I just wanted to say, yes, I think there is a biological difference between younger individuals and older individuals, and it deals with testosterone. And I think that there's a difference there where testosterone, you kind of want to stay up longer versus maybe not as much testosterone. Patrick Down says, comments suggest mainly genuinely believe I have no idea what the heck I'm talking about. I'm a delusional moon boy. These people just refuse to do the basic work of calculating the number of operational reactors, pounds of demand versus operating mines, pounds of supply. It's not hard. And you're going to get a lot of slack, Patrick, and you are completely right. The difference is people know the price of everything and the value of nothing. And what you're calculating is the differential between the supply and demand, which will eventually determine the valuation of uranium stocks because the uranium price drives the value of those stocks. You're looking at it from a long-term perspective. Everyone else is swiping left, swiping right in the short term. And that's where the advantage of the retail investor is becomes apparent. And you have to do things different than everyone else. You have to buy when they're not buying. You have to adopt a longer time frame than what they adopt. You have to do things different if you want to make money because the majority of people don't make money. And they're going to come and they're going to troll everyone. They're going to troll me. They're going to troll other people. They're going to say you're wrong. And they're just looking at it from a very short term, price only perspective. The value of where you make a lot of money is deciphering between price and value and taking a long term time frame. That's where all of the value is because no one else wants to do it. They want to get rich, they want to get rich quick, and they don't care about what they are looking at. So they hop from they just chase price. It's a fear of missing out, chasing price, hopping from one sector to another, chasing potential returns. And what's going to really get hurt is there's probably going to be a lot of people in crypto that are going to get absolutely wiped clean because everyone is in crypto. They have no idea what it is. There's no value there. And when the when the wrong market conditions come for crypto, which I think it's coming, they're going to get smoked. They're going to get smoked because you got a whole bunch of people in crypto that have no idea what they're doing. They're all very new investors, and all they care about is I want price movement and gains, and they just care about price. And we'll see how that plays out. Unusual Whales, it says the average American feels they need to earn over $180,000 to live comfortably for USA Today. Do you agree? I wouldn't say that to be an individual that you need that amount of money. I think it's lower if it's just you as an individual. If it's a family, then yes, I definitely think you need like mid to upper 100s to live comfortably. Yes, I would agree with that if you have a family. Now, it all depends on what comfortably means because comfortably means completely different things for a lot of different people. That's all I'll say. What car brand is most likely to make it to 200,000 miles without major mechanical failure, engine or transmission? His answer is Toyota. I would disagree. There are certain Toyota models, specifically some of their trucks, that are very good, but their cars in the mid 2000s and maybe even the 2010s, there's a lot of duds. My answer, undoubtedly, would be Honda, well over Toyota. And for a driving experience of value, Mazda's number one. So Mazda's number one for value and driving experience. Honda's number one for mechanical failure. And that is actually proven, at least engine transmission wise, by statistical rates. Toyota is not better than Honda when looking at the drivetrain only. Honda, I've had multiple Honda cars. Same with my parents. We've had multiple Toyota cars. Same with girlfriends and stuff like that. So we've thoroughly tested, I would say, Honda and Toyota. I am not a fan of Toyota. I think their clutches on their Corollas and Matrixes are garbage. They have problems with burning oil in their engines, specifically the 1.8 liter. And they've had other problems that we've run into with just drivability and some of the things failing on the car. It's not too bad though. Honda undoubtedly is a better product, in my opinion. And I think it feels more solid when you drive it. It's a better connection. Mazda is superior to all of them in terms of the person and the interaction with the car. And then when I drive other cars, I don't feel that same interaction. I also think that Mazda makes the most solid overall package for value. There's my opinion. Garrett says the Fed had to increase their balance sheet 2x during the 2-year Fed funds inversion in 2007. It was 2.3x in 2019. So He's thinking 2 times growth now equals about 16 trillion Fed balance sheet. It's coming. You don't own enough gold. And I do think that's the right market condition for gold to really do well under. It's a declining interest rate environment and a slowdown. And this is where all this stimulus crap comes from, and a lowering of interest rates. And that's right in gold's alley. So I know there's other people, they're looking at commodities. Commodities will do well, but I think gold will do well first. And then commodities will come after this slowdown period or whatever they're going to do, and however long it lasts. Metals weekly performance, gold number one, nickel, platinum, silver, tin. And then on the negative front, lithium, vanadium, and lead and aluminum taking it in the shorts there, buddy. Down about 5% for lithium, but up about 3% for gold and nickel. VIX seasonality update off the chart for the VIX there. That's looking pretty rough. And that is where I think I'm going to end it, guys. So that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.